These three figures represent the economic reality of the Netherlands in the winter of 1636. A skilled craftsman earned roughly 300 guilders a year. A townhouse on a prime Amsterdam canal cost 3,000 guilders, and a single Semper Augustus tulip bulb sold at auction for 6,000. 3 months later, that same bulb was worth almost nothing. The buyers had disappeared, and the market for rare tulips had vanished. Many historical accounts attribute this to a moment of unique madness, an era where an entire nation grew suddenly and inexplicably greedy. However, the data suggests this event followed a specific sequence of economic and psychological stages, a pattern that has reappeared in nearly every major financial crash of the last 4 centuries. By tracing the variables that pushed the Dutch market towards its breakdown, we can see how the first recorded financial bubble was actually built. The process begins with the economic environment of the 1620s. The Dutch Republic was the financial capital of the early modern world, operating the first modern stock exchange and a trading empire that reached Japan. The Dutch East India Company, or VOC, dominated global trade. Its success allowed the company to pay regular dividends, distributing massive amounts of wealth to its shareholders. This influx of capital created a large class of merchants and tradespeople with significant savings to invest. Years of consistent economic growth gave these investors confidence in their own financial judgment. In this environment, speculation was a behavior validated by a decade of genuine success. This establishes the first condition for a bubble: an economy with high liquidity and a population accustomed to seeing investments grow. In the early 1600s, the tulip became the focus of this investment. Originally from the Ottoman Empire, these flowers were exotic status symbols for the Dutch elite. The most valuable varieties were broken tulips, which displayed dramatic, feathered patterns on their petals. These patterns were the result of a specific mosaic virus. The transmission of this virus was unpredictable. Even the most experienced growers could not guarantee a broken pattern, making the supply of these rare bulbs impossible to increase on demand. This limit on supply forced collectors into bidding wars. As more people competed for a fixed number of rare bulbs, prices began to rise steadily. This provides the second condition, a genuine scarcity that provides a logical reason for an initial increase in value. By 1634, the rising prices caught the attention of people outside the world of horticulture. Middle-class merchants and craftsmen began to enter the market. These new buyers were not interested in the flowers themselves. They bought tulips because the price was going up, and they expected to sell them later at a profit. This flowchart tracks how the market changed. As more people bought in to avoid missing out on profits, their demand pushed prices even higher. The tulip had transitioned from a garden plant to a financial asset. At this stage, the price of the bulb is no longer connected to its use as a flower. It is determined entirely by the expectation of future price increases. To keep the market moving during the winter, traders developed a futures market. This allowed them to trade bulbs that were still in the ground and could not be delivered for months. Trading shifted from physical flowers to paper contracts. These documents represented a promise to buy or sell a bulb at a future date, often at a price that grew with every transaction. Trading moved into taverns, where contracts changed hands multiple times a day. People with no experience in farming were now managing complex portfolios of flower promises. Finally, speculators began using leverage, borrowing money to buy these contracts. They were taking on debt to buy assets they hoped would continue to rise in value. By the end of 1636, the market was supported by a network of debts that relied entirely on the assumption that tulip prices would never stop rising. This raises a question. Why did experienced, successful merchants participate in a market that seems so clearly unsustainable in hindsight? We process risk by looking at the evidence around us. In 1636, the social proof was overwhelming. Every merchant who bought tulips had made a profit. Financiers predicted further growth. Based on this evidence, buying was a mathematically supported decision. The instability of the system is difficult to see when you are operating within it. To a participant, the decision to buy feels like a response to a clear and consistent trend. These market cycles are a product of how groups of people process information and respond to the success of their peers. The breakdown occurred on February 3, 1637. At a routine auction in Harlem, the auctioneer opened the bidding for a lot of bulbs, and for the first time, no one bid. The belief that prices would always go up was the only thing holding the market together. When that belief disappeared, the market collapsed instantly. Prices dropped by 99% in a few weeks. Bulbs that had been worth the price of a house were now worth the same as a common onion. Those who had used leverage were left with massive debts and assets that had no value. The futures contracts became pieces of paper that no one would honor. The crash forced the market price of the tulip to reconnect with the physical reality of the flower. The tulip crash provides a 5-stage framework that has repeated throughout history. It begins with a new asset and early profits. It accelerates as more people buy in to avoid missing out. It peaks with the use of debt and derivatives, and it ends in a sudden collective collapse of confidence. This sequence appeared in the 1929 Wall Street crash. It drove the dot-com bubble of 2000. The same variables of leverage and speculation led to the 2008 housing crisis, and we see it in the volatility of modern cryptocurrency cycles. The specific assets and technologies change with every generation, but as long as people use social proof to evaluate risk, the pattern of the bubble will likely continue to repeat.